Schemes to reduce NPAs. Schemes to reduce NPAs. First one, Joint Lenders Forum, JLF. Joint Lenders Forum, JLF. You can write under that, RBI issued JLF guidelines in 2014. JLF guidelines are issued by RBI in 2014. Under this, in case of default on a loan of rupees 100 crore, default on a loan of rupees 100 crore or more for a period of over 60 days, so over 60 days means it will come under which category? SMA 2, okay. So bracket you can write SMA 2. So for a period of over 60 days, banks or financial institutions can establish a joint lender forum. So just before reaching NPA, you can establish joint lenders forum if the loan is above 100 crore, okay. Next point you can write under that, within 45 days of its establishment, the JLF will prepare a corrective action plan, CAP. JLF will prepare a corrective action plan which may include hand-holding means additional loans, okay. So rarely this will happen because additional loan to promote stress related issues, okay. So hand-holding, restructuring of loans, that is mostly the possibility, restructuring of loan and recovery. Hand-holding, restructuring of loan and recovery. One more line you can write, CAP, the corrective action plan that we have discussed, CAP should be ratified by at least 75% of the creditors, by value and 60% of creditors by member. 60% of the creditors by number. One more line you write there, it replaced, means JLF replaced corporate debt restructuring, CDR, corporate debt restructuring guidelines of 2013. Okay, so that means during this process there will not be any legal process, okay. After this only the things and the issue will go to the court. So JLF will be established not to take the issue to the court but to go for restructuring or recovery, and after that it will go to the court. Now second point that you can write here is strategic debt restructuring. Strategic debt restructuring, SDR. So RBI issued SDR guidelines in 2015. RBI issued. See, these all you need to remember, and this question, if it is asked related to NPA, you need to write all these schemes. JLF you need to write, SDR you need to write. Okay, that's why I'm dictating this. So SDR guidelines issued in 2015. In case of default on a restructured loan, the the JLF can convert its debt into, the JLF that we have discussed already, JLF can convert its debt into equity, okay, equity of the company, and can take over the management of the company, So I hope you might have understood this. So debt is there, and this debt can be converted to equity. That means the bank will have the financial institution or the lender will have the share in the company, and then if it is beyond 51 percentage, you can take over the management of the company also. So you can write one more line: JLF must be holding at least 51 percentage of JLF must be holding at least 51 percentage of the total debt of the company. So 51 percentage of the total debt of the company. Next point, the JLF will strive to revive the company. The JLF will strive to revive the company and sell its stake to another promoter within 18 months. Okay, so basically you have given loan, and you are facing the problem of it became a stressed asset, okay, or SMA asset. So this debt will be converted to equity. So you will take over the company in terms of management if you have 51 percentage or more shares there, and then you will try to revive it, and then within 18 months you will sell it to another promoter so that you can recover that money and everything. Now one more case you can write, one more scheme you can write: scheme for sustainable restructuring of stressed assets, S4A, 2017. This was a question in prelims. S4A, scheme for sustainable structuring of stressed assets, S4A, scheme for sustainable structuring of stressed assets. Okay, so introduced in 2016. Okay, now here the difference is, earlier the complete debt will be converted to equity, right? Now here, out of this debt, if the company may be able to pay 60%, okay, so if the company is able to pay, let's say 60%, rest of the 40% will be converted to equity. Earlier, the entire 100% will be converted to equity, right? Under SDR, it will be completely, equity, but now here, whatever company can pay, company will pay, the balance will be converted to equity. So that is the idea here. So it will reduce the burden on the company. Whatever the company can pay, that much you will pay. So here part of equity, above it was 100% full equity. So just write one line over there. Under the scheme, banks or financial institutions can bifurcate their loans into sustainable and non-sustainable components. So this is what sustainable component here. This something which they can pay back. This is non-sustainable. This 40% they cannot pay back. Okay, so it will be divided into sustainable and non-sustainable components. Under that you can write sustainable component of the loan consists of that part of the loan which can be serviced. Means in bracket you can write paid back. So this can be paid back. So the company or the firm is capable of paying 60%. It can be serviced by the company as per its current revenue. It can be paid back by the company as per the current revenue. In bracket you can write cash flows. It should, one more line is there, it should consist of at least 50% of the total loan. It should consist of at least 50% of the total loan. So minimum 50% should be able to service, okay, should be serviced by the company. What if it is 40%? If the company is ready to pay only 40%, then what will happen? Then S4A is not the case, then SDR is the case. SDR. Yeah, that is the difference. Then SDR, then the company will be, the complete debt will be converted to equity, and SDR, like what we have discussed before. So if 50% or more can be paid back by the company, rest will be converted to equity, like that. One more line you can write, non-sustainable part of loan will be converted to equity of the company. Will be converted into equity of the company. Okay. Next you write, next scheme, SURFACE Act 2002. SURFACE Act 2002. Okay. Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. You want to write the full form, or you will refer and you will write it? Or okay, you can complete it, write it. Securitization and Reconstruction of Financial Assets. Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act. Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, SURFACE Act. So as per this act, actually you don't want any permission from the court to recover. Okay, so the recovery process can be done even without the permission from the court. So just write one line over there. It enabled the banks or financial institutions. It enabled the banks or financial institutions to recover their dues. Through sale of collateral assets. Without intervention or permission of court. Okay, now you write an amendment in that. Amendment in SURFACE Act. So the district magistrate, the DM, will facilitate the process of auction of collateral securities. The DM will facilitate the process of auction of collateral securities, and also to take over the management of the company under SDR guidelines. Can you please repeat? Yeah, the DM, district magistrate, will facilitate the process of auction of collateral securities. The DM will facilitate the process of auction of collateral securities and also to take over the management of the company under SDR guidelines. So in case of recovery or in case of auction or in case of taking over management, it is the DM who have to facilitate this. Okay. One more point you can write under that. There is a provision of establishing a central registry to maintain records of collateral securities. One more term you can write there, willful defaulters. Just write faster. These are companies or individuals who default on bank loans. Under that you can write different cases. Who default on bank loans, and then you write despite having repayment capacity. That means they have the assets but still they default, right? Like Vijay Mallya. So they are willful defaulters. So these are companies or individuals who default on bank loans despite having repayment capacity. Okay, are we okay? There is these are simple topics. That's why I'm not explaining too much here.
The recovery can be done by selling the collateral securities, right? So
yes.
They don't have fear of this?
Who don't have fear of this? These willful defaulters. See, actually for that you need to know another concept, that is limited liability company. If this this loan is taken by a limited liability company, his liability is actually to an extent of the ownership or the shareholding that he have, maybe 20%, etc. So he might have diverted the funds also. So second case you write under this, divert funds to other activities or assets. That different types of company like partnership firms, limited liability, all this we will discuss later. So then you will understand the issue of Vijay Mallya. Okay, actually you can't sell the personal property. The company and the personal property is different. Okay, company and the personal property is like distinct entities. You cannot recover from the personal property if the company is defaulting. So if like Kingfisher is defaulting, you cannot touch the other business. Only this you can recover. That is a problem. Okay. So divert funds to other activities or assets.
So what happens when the company is subsidiary of a parent company?
Then the parent company will be having some shareholding, no, about in that company. That much, to the extent of shareholding you have, that much recovery is only possible.
Okay.
That means you are liable to, if let's suppose I am starting a company and if it is a limited liability company and let's suppose I have 20% shareholding in the company, I have the liability of only 20%, not beyond that. And my private property cannot be attached for this default of that particular company.
So what's the process of someone, like how they are considered willful defaulters? Like how Kingfisher was considered a willful defaulter? What's the process of declaring someone as a willful defaulter?
Yeah, I've told you now. One is despite having the repayment capacity, you are not paying. That is one case. And you are taking loan for activity X, but you are diverting this to activity Y. Like different cases you have seen recently. Okay, so this is also considered as willful defaulter. And you sell the collateral, you are pledging the collateral, okay, and you are taking the loan, but without informing the bank you are selling the collateral. All these are considered as willful defaulters. One more you write there, sell the collateral assets without informing the banks. Sell the collateral assets without informing the banks. So these three are considered as the willful defaulters. You are not paying despite having the capacity to pay, and you are diverting the funds to other activities and selling the collateral assets without informing the banks.